Hi, I'm Roger Montgomery from the Montgomery Fund and welcome to this week's Video Insight. Well, if you cast your minds back to September last year, you might remember I was on the television with Ticky Fullerton on the ABC talking about being on the cusp of a boom in the stock market. The three reasons were pretty simple. Investors were suffering from low interest rates. The bulk of those investors were baby boomers and there was an increasing number of them, and they had a disproportionate amount of money in cash earning those low interest rates because they sold out of the stock market during the GFC. Well, since then the stock market is up about 4%. What's interesting though is the number of companies that are frighteningly expensive. Boral, I notice, is on a historical PE of 25 times, and this is a cyclical brick maker. So you can imagine my surprise when I find companies that are far riskier trading on even higher PEs. Such is the extent of the rally in the stock market and the level of inquiry we have at our office here at the Montgomery Fund for investing in stocks because interest rates on term deposits are so low that I'm tempted to think that this rally might run out soon. Having said that though, there are some stocks that represent what we believe to be good value, and I'll run through some of those in just a moment. But before I do, what are the risks associated with investing in the stock market today? Well, it's simply this. The conditions that are causing the low interest rates that are driving everyone into the stock market are not good. The conditions are such that the Australian economy is worsening. It's deteriorating in terms of its rate of growth, its ability to employ people, to generate income, to then go and spend. China's growth is nowhere near the 7% that it reports, and it's fast heading towards 3 or 4%. Australia is tied to China through commodities, and we could experience a hard landing. But that expectation of a hard landing, which is also driving the Australian dollar lower, is the reason why interest rates are low, which in turn is the reason why everyone's investing in the stock market, driving stocks higher. If you believe that that scenario is going to continue, then you should believe that stocks will remain supported, but you shouldn't buy expensive stocks. So which are the ones that you should be researching or speaking to your advisor about? And remember, we suggest, in fact we insist, you speak with a personal professional advisor before buying anything. Well, those stocks can be, fit in to three sectors. The first one is wealth management, and wealth management companies that we believe are of interest are Challenger and Magellan Financial Group, both of which are trading below our current estimate of their intrinsic value. The next sector is healthcare, and the two companies that we like there are Medibank Private and Certex. Now Certex is trading above our current estimate of its intrinsic value, but if the trial results that we expect to receive in March are positive, and we believe it's just a matter of how positive they'll be, that intrinsic value could spike significantly. And the other and Medibank Private, obviously, many people are thinking, I think, too short term there. The long-term perspective is to remember that the population of Australia in 30 years' time is going to be double where it is today, some 44 million people. And the third area, of course, is the finance sector. And particularly in the finance sector, we like companies like some of the banks, although many of them are now too expensive. The other company we thought which might be of particular interest at the moment, given what's going on in Canberra, is Macmillan Shakespeare, which again is trading below our current estimate of intrinsic value. So there's a list of companies that we reckon represent good value in a market that is otherwise extremely expensive, and therein lies the risk. While the companies that we've described we believe are cheap, the rest of the market, if expensive, could fall at any time. So do the research, make sure you speak to your advisor, keep in mind that we own these stocks already, and I look forward to seeing you next week. Make sure you follow us on Facebook and Twitter.